The price did not climb. It appeared. Silver opened with a void beneath it, a clean vertical absence where trades used to exist. And by the time anyone was permitted to speak publicly, the market had already accepted 75, as if it had always been there. Screens refreshed, charts redrew themselves, commentators reached for explanations that arrived too late to matter. A gap is not a rally. A gap is an admission that the previous price was a fiction maintained by participation, and participation has quietly ended. This is how monetary events actually occur, not with alarms, but with silence. In 1933, Americans did not wake up to chaos, they woke up to legality. Gold was not stolen in the night, it was reclassified by decree, and the price was raised only after possession had been neutralized. In 1971, there was no panic run on Fort Knox. There was a weekend announcement, a closed window, and a promise that nothing fundamental had changed. In 2008, deposits did not vanish on screen. Confidence vanished off screen, and emergency facilities replaced markets while the language of stability was preserved. Silver, gapping to 75, belongs to the same bloodline of events. The surface remains calm because the decision has already been made underneath. The mechanism is not complex, which is why it is never explained plainly. Paper silver is a derivative of a derivative, a claim on a claim, priced by volume rather than by availability. It trades in quantities that dwarf the amount of metal that exists, because it was never designed to converge with reality. Cash settlement is not a contingency. It is the destination. As long as participants accept currency in lieu of metal, the illusion holds. The moment enough holders decline substitution, the market stops negotiating and jumps to where supply might be coerced into appearing. That jump is the gap. For years, this imbalance was managed through suppression that looked like liquidity. Large sell orders during thin hours, rolling contracts that never approached delivery, margin changes that punished insistence. The goal was never to keep silver cheap. It was to keep it irrelevant. Gold was treated delicately because it sits inside central bank psychology. Silver was treated brutally because it sits outside it. Silver is small enough to control until it isn't, and when it breaks violently because there is no depth beneath the paper. The overnight repricing was followed by procedural calm. Exchanges widened limits. Volatility controls were invoked. Certain instruments paused while others continued. Nothing was halted in the official language. It was merely adjusted. This distinction matters. Control in the modern system is exercised by rule changes, not force. Ownership is tolerated until it interferes with settlement. Then, settlement is redefined. The silver gap forced that redefinition into the open, and the response confirmed what insiders already knew. Delivery is optional. Cash is final. The market exists to protect the system, not the participant. The reason recovery is no longer possible is that the system has exhausted its narrative elasticity. Every prior crisis relied on belief in restoration. Gold would return to circulation. The dollar would remain as good as gold. Banks were illiquid, not insolvent. Each claim bought time because the underlying structure still expanded. This time, expansion itself is the problem. Debt saturation, demographic decay, and geopolitical fracture have eliminated the surplus trust required to restart the loop. When silver reprices, it is not forecasting inflation. It is pricing distrust. Banks feel this first because their assets are promises and their liabilities are confidence. A metal that cannot be printed exposes that mismatch immediately. Balance sheets depend on stable correlations and predictable collateral values. A discontinuous move in silver destabilizes those assumptions without announcing itself as a banking event. Liquidity drains sideways. Credit tightens quietly. Risk models are recalibrated internally while public statements remain unchanged. Accounts still display balances. Access still appears normal. This is how fragility is hidden until it is irreversible. Mainstream media performs its function by shrinking the event. Industrial demand is blamed. Retail enthusiasm is mocked. Charts are overlaid with technical indicators that imply control where none exists. The omission is the message. No one explains why a commodity with ample inventory cannot trade smoothly. No one asks why settlement rules change precisely when delivery is requested. Silence is not ignorance, it is alignment. The role of the narrative layer is to delay recognition until adaptation is no longer possible. Beyond markets, the silver gap accelerates a shift that has been underway for years. Eastern systems do not need Western price discovery. They need metal, energy, and bilateral settlement. Accumulation has already occurred. Infrastructure has already been built. When Western paper markets fracture, Eastern trade does not stop. It bypasses. This is not ideological. It is arithmetic. Control migrates to whoever settles in reality rather than abstraction. Silver repricing is not a victory for any bloc. It is the exposure of asymmetry. Monetary debasement follows predictably, not as policy error, but as necessity. When confidence erodes, currency issuance replaces consent. Purchasing power is diluted rather than confronted. This is not confiscation as history remembers it, with soldiers and seizures. It is confiscation through control, through inflation, through access restrictions that render nominal ownership meaningless. You keep the number, you lose the function. The silver gap is a warning flare because it demonstrates that prices can change without permission, and the response will be to ensure that people cannot. For individuals, the risk is embedded in infrastructure, not choices. Savings exist within institutions that answer to stability mandates, not depositors. Brokerage assets are rehypothecated by design. Pensions depend on uninterrupted liquidity. When volatility rises beyond tolerance, protections are applied. Withdrawals are delayed. Conversions are restricted. None of this is framed as loss. It is framed as protection. This is how freedom erodes while legality remains intact. The movement toward 100 is not momentum. It is clearance. It represents the level where enough paper claims are extinguished to rebalance the fiction temporarily. Each attempt to cap it requires more visible intervention, and each intervention accelerates exit from the system it protects. This feedback loop cannot be stabilized because it is psychological as much as financial. Trust, once broken, does not respond to policy. It responds only to distance. This narrative is not financial advice, nor is it a recommendation of any action. It is a description of mechanisms already in motion, observable only if one stops listening to explanations and starts watching procedures. The silver gap is not an isolated event. It is a signal that the boundary between price and control has been crossed. From here, markets will continue to function, but only in the way a stage set functions after the audience has left. What remains unresolved is not where silver trades next, but who is permitted to participate when it does. As rules multiply and access narrows, the distinction between ownership and permission will sharpen. The system will insist it is preserving order. It always does. And somewhere between the number on the screen and the ability to act on it, the final transfer will complete itself quietly, efficiently, and without ceremony.